When it comes to executing an investment philosophy, investors need to be aware of the different transaction costs that they might incur when buying or selling assets. So, portfolio management does not exist in a vacuum. What we know is that there are a number of frictions that investors encounter when they go about investing and executing an investment strategy. One of those frictions is taxation, and we spoke about taxation briefly in the previous learning objective. But perhaps the most prominent and profound market friction is trading costs. So trading costs are the costs that we incur when we go about buying and selling assets. Let's look at a quick example of a trading cost. So an active investor might be trading because they believe that there is some profit in doing so. There might be some market inefficiency that they seek to exploit. When that active investor goes about calculating their return, what they need to actually calculate is not only the return that they've generated, which might be the expected return or the market return, plus any alpha being the abnormal performance that they've generated due to that active investing. But what they also have to do is then take off the costs of trading. And we know that the more active an investor is, the higher those trading costs might be. So what we know is that in total, an active investor actually tends to underperform the market. And the reason for that underperformance is that although the alpha component of this equation is positive, which means that if we assume a frictionless market, if there were no trading costs, then an active investor can actually outperform, yet that outperformance is more than subsumed by the costs incurred by that additional trading. Okay? Those costs can be anything up to 1%. So this is a really good example as to why it's important for all investors to be cognizant of trading costs and keep them in mind when executing their investment philosophy. So what are these trading costs and what are the components of them? Well, trading costs tend to have three different components. Those components are the brokerage cost, the Bidask Spread, and the price impact. And for this learning objective, we're going to go through all three of them in some detail. So brokerage costs, first of all, this is the most explicit cost. It's the one that investor pays every time they buy and sell a stock. Now, anyone who themselves has bought or sold stocks, for example, will be very aware of this. Okay, let's say you go on to an internet broker and you decide to buy, let's say 200 BHP shares. And when you buy those shares, there will be a cost of executing, which might be, for example, $20 per share. That cost of executing that is our brokerage cost. Now, we pay brokerage when we buy shares, and once again, when we go and execute the sale of those shares, we also have to pay brokerage costs. So it might be $20 in, $20 out. Now, brokerage cost is fixed, and as a dollar amount, it's relatively small. Hence, for large investors, brokerage cost is a very small percentage of their total investment. Though brokerage cost can be quite significant for small retail investors. Now, let's say you're only going to invest $1,000 in a particular stock. Well, if you're only going to invest $1,000 in a particular stock, but you're paying $20 to buy that stock and $20 to sell that stock, what that means is that you are paying 2% of your total investment to buy and 2% to sell, or you've got net round-trip transaction costs of 4% of the total investment. So giving up 4% before you even start. Now, a lot of institutional investors will also have their own in-house brokerage. They'll have a brokerage license, hence they can directly access the stock exchange, so they don't have to incur this cost. But for individual investors, it's important that they need can only trade via a broker. Second component is the Bidask Spread. Now, anyone who's looked at financial media, for example, will know that when you have a price of any stock, or the same applies for other assets such as currencies, when those prices are quoted, there'll actually be two prices. There'll be the bid and an ask, or a price that you can sell those assets for and a price at which you can buy them. And the difference between those buy and sell prices is implicitly a transaction cost, and we call that the Bidask Spread. Now, I think the best way to think about a Bidask Spread is to think about the last time you were in an airport and there was the foreign exchange board where you can buy and sell currencies, and you will know that there's often those red numbers, and those numbers will be different, and there'll be a big difference between what you can buy and sell currency for. Okay, that's another transaction cost. In the case of that foreign exchange, That's both the risk that the foreign exchange broker is taking on and also a proportion of their profit. Last, and often most importantly, but often this is the most opaque of all the aspects of transaction costs, is the price impact. Now, particularly if you're a large investor, the very process of you buying or selling stocks can actually have an impact on the market price. You can actually move the price through your trades, given a price is merely just a function of supply and demand. Okay, if we think about basic economics, where we have a supply curve and a demand curve, what happens when there's an increase in the demand for a particular stock, or if there's an increase in demand with no change in supply, the price is going to increase. So that increase in price will mean that by virtue of your trade, you pay a little bit more than what you might have otherwise expected, or what might be the quoted price, and that also becomes an implicit cost of trading. Let's dive into these in a little bit more detail. So I mentioned before brokerage costs. So a broker is a representative appointed by an individual investor. Okay, brokers are an important part of markets because they protect the market integrity. They prevent individual investors from merely going and buying and selling because that could create problems. Now there's two different types of brokers. A full service broker is a brokerage house that not only executes trades but will offer a full range of service such as advisory services and research services to the investor. Full service brokers could cost anything up to $200, $250 per trade in terms of executing. So they can be quite expensive, and what an investor needs to weigh up is whether those additional costs are outweighed by the benefit they're receiving from that full service broker. A discount broker, on the other hand, is like your traditional internet-based brokerage service, okay, like your ComSec, for example. These brokers generally charge between $15 to $20 in the context of the Australian market in order to execute trades, although often can be quite cheaper in other international markets. But basically, all the discount broker tends to do is just execute the trade. So they don't provide the additional advice that the full service broker do. Hence, the cost of that transaction is significantly cheaper. Second aspect we looked at before is the bid-ask spread. Okay, so what we know is that whenever an asset is quoted, as I mentioned before, there's two prices. Okay, there's the price that someone wants to buy for and the price that someone wants to sell for. And the difference between these two prices, the difference between the bid and the asked price, is an implicit transaction cost. The reason for that is because if you want to buy and if you want to execute your trade immediately, then the best price that you can, for example, buy for is the lowest price that someone is currently willing to sell for, which means you have to cross that bid-ask spread and incur a slight cost because of that price differential for doing so. So a simple example of this is, let's imagine that we've got an order book that looks something like the following. We've got a stock where the current mid price is $10. Okay, so that's the average between the bid and the ask price. And then each of these stacks that we can see is demand to buy and sell the stock. So the blue stacks on the left, these are orders that people have placed to buy stocks. Okay, so we've got, for example, currently a demand of 1,000 stocks to be bought at $9.97, 900 stocks to be bought at $9.96, and so forth. On the right, the red stacks, that is the current order book or the current volumes and prices which people have currently placed orders to sell. So currently there is orders to sell 1,100 of these stocks at a price of $10.03, 820 at $10.04, and so on. Now, as this market is currently sitting, as this order book sits right at this point in time, no trades can take place because there is no point at which there is a matching of an offer to buy and an offer to sell. So let's say that you came in and you placed a market order to buy, which means you said, I want to buy immediately, I want to execute immediately, and I just want to buy at the best possible price that I can buy for. So at the moment, the most someone's currently willing to pay to buy this stock is $9.97. If you want to execute immediately, you have to cross this spread and you have to pay the best available price that someone's willing to sell for, which is $10.03. So that difference between those prices, going from $9.97, crossing that spread to $10.03, we call that the bid-ask spread, and we argue that that's actually a transaction cost. so the cost of jumping from one stack to the other. Now, the bid-ask spread is actually not the same for all stocks. There are a number of different factors that can affect the bid-ask spread. Some of those factors include, first of all, liquidity. So the more frequently that the stock is traded, the lower the bid-ask spread will be, or the smaller the difference between those two values. Also, the riskiness. We find that riskier stocks tend to have a bigger spread. The price level can have an impact because the bid-ask spread is measured as a percentage, and what we find is that stocks with a higher price will tend to have a lower bid-ask spread as a percentage. And also, related to this idea of risk, the degree of information transparency relating to that particular stock or asset. So information transparency and corporate governance, those stocks that have less transparent information will have a bigger bid-ask spread. So thinking about this, let's look at a quick Australian example. Thinking about these different factors of bid-ask spread that we talked about before, and thinking about his example of 6 Australian companies ranked in terms of their size. So we've got the biggest, the 10th biggest, the 50th, the 100th, the 500th, and the 1000th biggest stock. And just in terms of size, and as we go down, so not only are we looking here in terms of big companies through to small companies, we also have, by virtue of the fact that these companies down the bottom, they're much smaller, they tend to be much riskier, and often they'll have less transparent information. And associated with that, we can see, as we go from the big stocks to the small stocks, there is a significant increase in the bid-ask spread. Okay, the bid-ask spread is not the same for all these stocks. In fact, it's quite small for large companies like Commonwealth Bank, only 0.13%. Yet the bid-ask spread for the 1000th biggest stock in the Australian market, which is KGL Resources, is a huge 8.33%. Okay, so that means you are giving up 8.33% of your total amount available for investment just to cross that spread and buy the stock. It's quite a large transaction cost to pay. Third and final component of transaction costs that we need to consider are price impacts. Okay, we know that markets are not completely liquid. What that means is that there are not an infinite number of buyers and sellers for every stock at any one point in time. And what this means is that sometimes there can be an imbalance between the price, the volumes and the prices that people want to buy and sell for. And what happens with respect to that imbalance is that if there is a really large order to either buy or sell, that order can actually move prices. Let's go back to our example before and give a demonstration of this. Okay, let's say that someone has come in within this market that we showed earlier and placed a block order to buy 2,500 stocks immediately. Okay, how will that order actually be processed? Okay, well, what we would have here is we can see that they're executing immediately, so they've got to buy at the best available price. Okay, so they would come in and first of all, they can buy their first 1,000 stocks at this price here of $10.02. So the first 1,000 of that order of 2,500 stocks gets executed at $10.02. But then because that order has now been taken up, it disappears out of the order book. And this investor still wants to buy another 1,500 stocks. So the next component of that order is filled at the next best price. So we've now got an offer to sell 900 stocks at $2.04. Okay, so they cross the spread and they buy their next 900 stocks at $2.04. Okay, so they've now bought a total of 1,900 stocks, but they want to still, they've got an order for 2,500. So the next 200 is filled at a price of $10.06, and so on. We can see eating into the order book there. And that additional price that the investor's paying beyond our first stack, which is just the cost you pay from crossing the bid-ask spread, the growth of that spread, or the additional price that's paid, by virtue of the fact that that large order has moved market prices, we call that the price impact. So one obvious question then is, can't you avoid either the bid-ask spread or the price impact simply just by waiting? Why does an investor just sit on either the bid or the ask price rather than crossing that spread to buy and sell for themselves? Well, there's a good reason for that, and that is because there is an opportunity cost of waiting. So what we might find is that we've got some profit-making opportunity. We might have observed some mispricing in the market. And because markets are relatively efficient, if we don't act on that instantaneously, chances are there might be some other investor who comes in and takes up that opportunity before us. So we want to go about executing immediately, and in that case, waiting can have a cost associated with it. And in that case, that cost is an opportunity cost. So investors need to balance up the explicit transaction cost, which is the costs associated with executing immediately through the crossing the bid-ask spread and paying the price impact, versus the implicit costs of opportunity cost of waiting if they do happen to wait to trade.